Will the Feds repeat the blunders they made during the 2020 lockdown? This week, the Federal Reserve announced that they will keep the interest rate steady at 5.4% with 3 expected cuts in 2024. This has put a pause to the crazy surge in interest rates that we have seen recently. This decision can have a huge impact on the U.S. economy in 2024, but is this enough to save America from going into recession? Well, we can figure that out by investigating what they did last time to try and stop the economy from collapsing during the COVID-19 pandemic. The Feds massively decreased interest rates during the 2020 lockdown, taking it down to almost 0%, which means they were basically giving out loans for free. It made sense to do that at that time because the lockdown meant businesses were slowing down, so cutting the rates was a good option. This gave the opportunity for businesses to borrow more while paying less in interest so that they could hire more people, increase production, or at least stop them from going out of business. Those rate cuts were a good reaction from the Feds, but it was soon followed by a bunch of bad decisions. It is natural for the flow of money to increase as it becomes cheaper to borrow, and this excess money can create inflation. So the obvious next step for the Feds was to start slowly increasing the rates to make sure the inflation doesn't become that big of a problem. The timing of this decision is very important because if you wait for too long, it can lead to some bad outcomes. This decision might sound so obvious, but even though they are the Federal Reserve of the biggest economy in the world, they did not increase the rates until it was way too late to control inflation. By the time they finally decided to increase rates, inflation had gotten so out of control that they were just panicking and increasing rates again and again, in the hopes of things calming down a bit. This led to the highest interest rates and inflation the country has seen in decades, and they might be making the same mistake again. Although this time, they have built up enough pressure on inflation with this higher rate that inflation is slowly getting under control and is moving closer to its target of 2% day by day. Those same rates have also put immense pressure on businesses and the economy. Everyone is looking forward to this pressure being relieved so that they can use debt to buy their much-awaited house, car, or other items that they have been putting off buying due to the higher costs of borrowing. The react after it happens method didn't work for them last time around, so it's very important for them to be proactive this time. Because if they decide to hold the rate as is and not slowly start to reduce it, it will not only not take any pressure off the economy, but can lead to layoffs, a decrease in growth rate, and could lead America to a recession. On the other hand, if they decide to reduce the rates too quickly, that can create some serious problems as well. As people have been struggling with inflation for a couple of years now, if they suddenly drop the rates, people might start aggressively buying stuff that they have been waiting to buy for years, and this can bring inflation back. So the situation needs to be fully in control before any drastic changes take place. So here's what the Feds can actually do. As much as we would love them to be proactive, it's very hard to be so because the economy is an ever-changing beast of a machine. Things like financial crises and politics are also factors which they have to consider when making interest rate decisions. So this rate hold will give them some time to see how the market reacts to this decision. Hopefully, how the public reacts to this rate hold will give them a solid guideline for the next decision. I think it's in their best interest to hold rates for now and then start dropping them very slowly while giving the market time to adapt and react to it, so that we don't see the same shock of interest rate changes which we saw in the last couple of years. While other economic factors are pointing towards a slowdown in the U.S. economy, a careful interest rate reduction throughout 2024 can be very lucrative for the stock market. All these people who are getting a good 4 to 6% on their savings account because of these high interest rates will start to make less and less in these safer investments as the rates reduce. This means to make some decent money, investors will be more open to taking risks in the stock market, which should increase the overall investment coming into the market. And as the basic rule of economics goes, when more people want to buy something, stocks in this case, the demand will go up, which will end up increasing the prices. The stock market isn't the only thing which directly gets impacted by this. A lot of real estate investors and buyers have been on the sidelines because the rates are too high to go and buy something. These real estate market participants are also waiting eagerly for the Feds to drop the rates, which means a reduction in rates should show an increase in the real estate market by the same economic law of demand. So it looks like as long as the Feds can execute these rate changes in a controlled and timed manner, they could manage to save not only the U.S. economy, but also the U.S. stock market. What do you think they will do in their next rate announcement? If you enjoy the video, don't forget to like and subscribe, and thanks for watching.